Dickey here. And once again, we have someone trying to get headlines and then contradict themselves. So, as most of you know, one of the things I try to do is try to show where we have a lot of contradictions and where people are just not being, first of all, accurate or in all reality telling the truth. So, his tagline here is U.S. economy in crisis. Here's what comes next. Now, my issue is if you really think the economy is in crisis, then again, back it up. Show me your figures, show me your numbers, give me some data that I can sink my teeth into. And here's my problem with it. Not just this gentleman, but a lot of other people that come out here and are trying to get taglines and are trying to get people to do their clicks and watch their videos and whatever. But he completely contradicts himself. So let's take a listen.
The US economy is in bad shape, and you should not expect the economy to get better anytime soon, thanks to the Federal Reserve.
Okay, just bear with me. First thing out of his mouth, the economy's in bad shape and you shouldn't expect it to get any better anytime soon because of the Fed. Now, keep that in mind when we listen to the rest of this.
I'm going to tell you what the Fed plans on doing next. In 2 weeks, the Federal Reserve will have their next FOMC meeting. That's going to conclude on November 1st. At that meeting, they're going to decide whether they want to raise interest rates higher or not. If you connect the dots, we already figured out what they're going to do. I want to lay it out for you. So I just want to save you the time. I want to tell you about the Fed master plan. So to understand where they're taking us, you have to first know what they're saying about the situation. And this is coming straight from the Fed minutes. This is their staff review of the economic situation. So they said that the data available suggests GDP is rising at a solid pace in the third quarter. The labor market continues to be tight. Unemployment is low. Job gains remain strong, and inflation is still elevated.
Okay. Now, you don't have to be a rocket scientist to understand what this is saying. GDP is rising at a solid pace for the third quarter. What part of that is the economy in crisis? The labor market continues to be tight. I don't like the word tight because it doesn't really imply what's really happening. And what a tight labor market means is that it's a good labor market for workers. Unemployment is low. Job gains are strong. Now it says inflation is elevated. It's at 3.7% on the CPI. So yes, it's higher than what they want to be at 2. But again, show me on here with the possible exception of the 3.7% inflation being elevated, where the economy is in crisis. Because I mean, I still can't say inflation's in crisis because the historical norm for the United States is 3.8. So if we're below the historical norm, how is it in crisis? I don't understand why this is getting any play at all.
And I want you to keep in mind that that's coming straight from the Fed minutes. The GDP result for the third quarter, that's going to be released in a few days. But the Federal Reserve of Atlanta is estimating that GDP growth will come in at 5.1%.
How is this a problem? Please explain this to me. How is a 5.1% GDP a problem or the economy in crisis?
And that signifies a very strong U.S. economy. The JOLTS report
literally just said, strong U.S. economy. And yet his tagline is the economy's in crisis. I don't even know what to say.
That shows that 1.52 jobs for every unemployed person. And the unemployment rate is at 3.8%, which is historically extremely low. The U.S. economy added 336,000 jobs in September. That's according to the most recent jobs report. But inflation remains elevated.
Look at this. Okay, yes, the target rate for the Fed is 2%. Now, he keeps saying that we've discussed this and gone over this. I've continued to say this, and I'll keep going over this. None of what this guy is saying, and none of this is the economy in crisis. A core CPI of 3.7% is not a crisis. Core inflation at 4.1% as it's continued to come down. And I want to show you this. So here's the core CPI. Take a look at it. It's almost a straight line, not exact. It's kind of gone up a little bit here, but we're down to 4.1%. And he'll say in a little bit that PCE is the bigger indicator. Okay. It's at 3.4, but what do they all have in common? And this is the part that really bothers me again, when they just give you these huge statements, grandiose statements without having any backing on it. This is the actual CPI, folks. This is how they calculate inflation. Where it says 100%, that means all of the stuff below it total up to this. Now food, these are subsections under food. So when it says 13.38%, All these bottom pieces roll up to this number, but it's 13 of the total 100. So all of food, all of it, is only worth 13%. Energy is only 7%. All items excluding food is basically 80%. And this is your core, okay? So you have to extrapolate out the part of this that's, to get down to core, it's just this 80%, okay? And in the 80%, you've got apparel, new vehicles. These are all the different components of it. Now, shelter is 34% of the total, not of core. When you take out the 20% that's non-core, the 34% goes up to roughly 39%. It is by far the largest percentage of the pie. Nothing else comes even close to it. You're talking 6%, 5%. Heck, everybody complains about airfares being up. It's only a 0.5% of the total pie. It could be up 10%. It's not going to affect anything. It's only 0.5%. As I keep saying, this is the major issue. We're at 7.2. We're not getting down to 2% until this thing gets significantly lower, and it's continuing to come down. None of the rest of this means a darn thing. I mean, you can talk about it all till you're blue in the face. I'm going to go back to the video because he makes a couple of comments that just make no sense. And again, aren't backed by any fact.
Well above the Fed's 2% targets. CPI inflation is at 3.7%. CPI core inflation is at 4.1%. PCE core inflation is at 3.9%. So this is where we currently stand. Now, I want to tell you what the Federal Reserve staff is saying about the economic outlook. So they said PCE inflation is forecast to be around 3.5% by the end of this year, the end of 2023. Inflation is projected to move lower in coming years as supply and demand in product and labor markets continue to better align. And PCE inflation is expected to be close to 2% in 2026. So I want to point this out to you, and this is coming straight from them. They're saying that they want to get inflation down to 2%, right? Well, they're saying that they think that they can do it by the year 2026. So this is not going to be a quick fix. This is going to be an ongoing thing for many years. So,
oh, horror of horrors. Again, show me where this is an economy in crisis. You're at again, depending on which one of these you want to look at, we're a little over 3% in inflation, okay? Even if we're closer to 4, it's not a crisis, especially when they're projecting that it's going to continue to come down. It took 19 months to get from 1.2% to 9%. Anyone who thought it was going to take any less time to get back down is an idiot. But more importantly, I don't understand why we continue to listen to this economy in crisis based upon nothing. I mean, nothing he's bringing up here is an economy in crisis.
just be prepared for that. Okay, the other thing I want to say is that the Federal Reserve, they like to use PCE inflation as their best way to measure inflation. They say that's the best way to gauge it. And they want to get it down to 2%, and they think that they can get it to around 3.5% by the end of this year. So they are projecting that it goes lower as supply and demand better align. And they keep on mentioning, this is why they keep mentioning the labor market, because it's because of wage inflation.
No, it's not. Which is why in the last meeting, Powell lowered his wage unemployment expectations from 4.6 down to 4. In economics, typically, and this is typically, these are models that have gone back for years and years and years, which may not be accurate, okay? But the whole point of the model is that when you raise interest rates to try to curtail inflation, raising the interest rates should, by definition or by models, raise unemployment. It hasn't. The reason it hasn't is exactly what he said on there. We have almost 1.5 times the jobs out there that we have in people. When this whole thing started, we had over 2 times. And I said this from the beginning, that's what you have to understand. He doesn't have to destroy the economy this particular time around because the economy is so strong. All he has to do is lower the amount of jobs out there with the number of people. And he needs to slow the growth of things. Again, none of what he's done has done anything. Again, I've said this, I'll continue to say it. The economy, the market was going to correct this, whether he did anything or not. So it was going to come down. But he's already learned this. Every meeting he kept coming out, and go back and watch the videos with him. He'd say at every stinking meeting, we don't know why. According to our models, we expect this. He never said he wanted to destroy the economy. Didn't say that at all. He just said, according to our models, we do this, this should happen. And then he'd come out the next meeting and go, okay, well, we did this and this didn't happen. Not that we actually understand why, but again, the models would predict this. And he kept predicting it over and over and over again because the models would predict this. And he didn't want to get away from the models. This was the first meeting that he came out with that he lowered the expectations on unemployment, which I don't know that I agree with. I don't think that was necessarily a smart choice, but that's what he did. And for me, when I look at Fed going forward, they don't have to do this. They've already got this. With interest rates, the treasury yields going the way that they are, they don't have to do anything. Now, the next meeting is really very simple. And he goes on to talk about some other things, but it doesn't make any sense. At this point, this is all you need to know about the next meeting. They're not raising. Unless something weird happens between now and then, nothing's going to happen. Everything we hoped for the Goldilocks, for the soft landing, or whatever you want to talk about, happened last week. You had CPI come in. It did not go up on the headline. The core came down, which is what you're looking for. The banks reported and were massively good, just an amazingly good. Nothing you could have asked for more on that. Nothing came out today any different, so that's a positive. But as far as Powell is concerned, when he comes out on the 1st, they're not raising. There's no reason to raise. There really isn't. And I hate to be that way, but I don't know what it would be. And I can't see a situation where he's going to do that. But he's also not going to tip his hand and say that he's not going to raise in the future. That would be stupid. He's not going to do that. He's going to come out and he's going to say that they're going to be data dependent, that they're going to follow the numbers, that this, that. And again, he'll come up with all sorts of stuff. The other nice thing this week that's happening is you got 15 Fed officials coming out this week. They're going to have a ton of things to say. I'm guessing the vast majority of them are going to sound relatively hawkish, but with a dovish overspeak or whatever you want to call it. But they're going to all say the same thing, that the market's doing its heavy lifting for them, specifically the treasury bills and yield spreads, because I'm telling you, as they continue, I mean, they were high and they pushed things higher, which at least a 1% increase in what the Fed might have tried to do. But it didn't need to do anything. All this is coming down. All that matters is shelter. We know shelter's coming down. You just have to watch the numbers as they continue to go down. Because of the way shelter is calculated and what the lag is, we don't have a specific number or a time frame when the lag is going to catch up. When the lag catches up, it's going to be big. And again, when it's 40% of the total pie and it gets down to, let's say it's going to go negative at some point. That's where I might be concerned. If unemployment actually does go up to 4.5 and real estate rolls over, then when I think we're going to have a recession. But I don't think it's going to be deep. I don't think it's going to be necessarily bad. But again, where is the crisis here? There is no crisis. Nothing he's put out here is crisis mode to me. So I don't understand it. Maybe somebody can explain it to me. Put it in your comments because, again, I don't see where the crisis is coming up here. Now, again, I'm not necessarily agreeing or disagreeing with him. My point is that he's saying the U.S. economy is in crisis, and none of the data he's putting out here has anything to do with the economy being in crisis. Now, he does make a comment a little bit later on in the video about there being two different kinds of people with money and people without money. Again, that's not a U.S. economy in crisis. That's just natural state of being. I'm not agreeing or disagreeing with whether that's true or not true, but we can beat this up infinitum about it. But, pre-COVID, post-COVID, whatever you want to look at, that's a simple fact of life. You have people who have a ton of money, you have some people who don't have a ton of money, and there the two shall meet. And the middle is what it is. And it shrinks and grows. And I mean, again, depending on how you want to define it. So that does not make a U.S. economy in crisis. It's just normal. So if you're going to come out with a tagline and you're going to probably push this narrative that the U.S. economy is in crisis, at least tell me something that is crisis, because you haven't given me anything yet. 3.7%, lowering core and a lowering PCE, and the expectations are lower. Strong economy, strong jobs, strong GDP. Yeah, when you listen to the banks on Friday, they all said that the consumer had a great balance sheet, that the consumer was continuing to be steady and spending money. And, again, whether the money from COVID is gone or not, that's been gone for a long time. Anybody was actually going to spend it. So I'm not exactly sure where the crisis is here. So talk to your financial advisors, make sure your portfolio is set up for your situation, not what this guy's talking about, because I'm again, unless you can give me something else, I don't see where the economy's in crisis here. Dickey out.